Did you know there are 4 parts to your mortgage payment? I'm Chris Bain at Keller Williams Realty. We're going to talk about that coming up. Welcome back to my YouTube channel. I appreciate you guys being here. If you wouldn't mind clicking that thumbs up after you watch this video, it will help my self-esteem a lot. Also hit that subscribe button and click on that little bell so you can be notified every time we drop fresh new content. Just like when you buy anything like a car, a boat, an RV, you're going to have to make a monthly payment on that unless you pay in cash. And in most cases, everything that you buy has parts to the payment. Well, we're going to talk about the 4 parts to a mortgage that you need to know that encompass your entire payment. So the 4 parts to a mortgage are your principal, interest, taxes, and insurance. And if you look at your statement you're given by your lender, it's typically referred to as PITI. So what is the principal? Your principal is the total amount of money that you borrowed from the lender. So if you borrowed $250,000, then your initial principal is $250,000. Now, as you make your payment every single month, a portion of your payment will go to pay the principal. But as your principal decreases, don't expect to pay less in the interest. We're going to talk about that in just a second. Now, your monthly payment is going to stay the same for the life of the entire loan, so that's good. Like rent can go up, your mortgage payment doesn't increase unless you have what's called an adjustable rate mortgage, but most people don't get those, so you really don't have to worry about that. Now, your payment will go down if you refinance your loan, but that's something completely different. So don't expect just because you pay a larger portion towards your principal that your payment's going to change. Now, the second part of your loan is the interest, and this is the interest that the lender charges for you to borrow the money to make a purchase of your home. So right now, interest rates are just below 3%. So that means, depending on your credit score, that determines the amount of interest the lender is going to charge you. Also, the more money you put down, the better rate that you're going to get. So let's say, for example, you're selling a home to buy a home. Let's say you sell your home for $300,000 and you make $150,000. Let's also say you're purchasing a home for $500,000. Now, 20% of $500,000 is $100,000, which means if you take that entire $150,000 and put it back into your new property, then your interest rate is lower. The better your credit score, the interest rate also helps you there too. Now, keep in mind when you do make a purchase on a property, there's 2 different types of interest. There's a fixed rate interest, which is what most mortgages were, and then there's an adjustable rate, which we had talked about just a second ago. Now, if a lender comes at you with a fixed rate mortgage, that means your mortgage payment isn't going to change for the entire life of the loan. Now, typically mortgages are done 15, 20, or 30-year mortgages, so it's absolutely up to you what you want to do. Just keep in mind, the shorter the mortgage period, the less interest you're going to pay. So even if you get a 30-year mortgage, if you can make an extra payment a year, that'll shave off years on your loan. Now, an adjustable rate mortgage, sometimes called an ARM, you'll get what's called a 5-1 ARM, which means that your rate is going to adjust within that 5-year period. So just keep that in mind. That will probably be the time that you want to refinance the loan. Right now, it doesn't make sense to do 5-1 ARMs right now because interest rates are so low. If interest rates were higher, it might make sense to be doing that right now. Let's say if interest rates were 6% or 5%, then the lender could get you an adjustable rate loan where you might pay 3% for the first 5 years, and then your rate will adjust after that. It just doesn't make sense to do it right now. So think about getting a fixed rate mortgage in this market because interest rates are so low and they're just under 3%. The third part to your mortgage is your taxes, and everyone has to pay those. Now, you can choose to not have your taxes what's called impounded into your mortgage payment. I think it's probably a good idea to do that because if you're like me, then you just set it and forget it and you don't ever have to worry about it. So when you get that tax bill, your lender will actually pay the tax bill to the assessor's office. If you choose not to, then you're going to have to save that money each and every month. So you have to be very disciplined because you're going to have to make the tax payment 2 times per year. So what are the taxes in San Diego? They're approximately 1.25% of the purchase price. So overall, if you're spending $500,000, you're looking upwards of about $7,000 a year for your taxes, and those are broken up twice per year. It's paid twice per year, and the taxes are always paid in arrears. So what that means is if you save the money with your lender, the lender is banking all that money, and then what they will do is they will turn around and wire the money to pay your taxes, so that way you don't have to worry about it. Out of sight, out of mind, best policy. I think you should do it, but if you want to save your own money, you can do that too. Now, the last part of your mortgage, that is the insurance. That is the I in PITI. And what that means is you need to have enough coverage for the lender to be satisfied to make sure if anything happens to your property that you're able to make sure that your investment is protected. If you have any questions about your mortgage, I can refer you to some great lenders that will be happy to help you out. I can answer very basic questions for you and put together some numbers so that way you can kind of know what to expect. If you have any questions, feel free to reach out to me at 619-818-2992. Thanks so much for watching. I'll talk to you soon. Bye-bye.